Consumer, meanwhile, showing some resilience. The University of Michigan Sentiment Index for September just posted its strongest number since the pandemic started. The report also noted that 40% of U.S. consumers are seeing positive economic developments, and that's the highest level in 6 months. But what if there's no more stimulus on the way from Washington? Goldman Sachs out today warning that if D.C. fails to pass meaningful stimulus, they'll downgrade fourth quarter growth estimates. Will that prove to be a major stumbling block? For that, we bring in Hugh Johnson, Chairman and Chief Investment Officer of Hugh Johnson Advisors, and Blurina Heisey is Fixed Income Trading Manager at Buckingham Strategic Wealth. It's great to have you both here. And Hugh, before I dive into that, what do you make about this big tech soft patch that we're moving through here? What does that tell you about market overall?
Yeah, it tells me pretty clearly, we've come very far, very fast from the March lows, 53% on the upside. That's a 106% average annual rate. Just common sense alone tells you that's an awful lot. And if I do the numbers, Kelly, quite frankly, we've gone from being undervalued, significantly undervalued in March, to being about 16% overvalued now. The reason we're having a problem in the overall market right now, investors know that we've come very far, very fast. They have a sense that we're overvalued. As I do the numbers, we are overvalued. And as true as that is for the stock market overall, it's also true for technology. And of course, those big names that we've been always talking about just about every day. So it's a valuation problem. Plus, let's keep in mind, there are additional significant risks right now. The risk of the second wave, which is a real risk. And then, of course, the perception that the Democrats might win the election. And they some investors associate that with fiscal restraint. That's an unfounded association. But nevertheless, some believe Democrats lead to fiscal restraint. I don't think that's true. But nevertheless,
Hugh,
those are two big risks. These are all big risks.
But let's go back to what you said about the market being overvalued. You said 16% overvalued for the whole market, overvalued for technology. Then this sell-off to you would be a welcome thing, would it? I mean,
yes.
At some point, you don't want it to keep going to the moon.
No, you're absolutely right. I've been waiting for this, quite frankly, looking for this kind of a sell-off for over a month now. And yes, you bet. I think it has to get down. Again, I mentioned 16%. It has to get down to a level where I can feel a lot more comfortable buying stocks. And that's true of the overall market, but it's certainly true of technology. So you're absolutely right. Bring it on, because I don't feel comfortable buying stocks at current valuations. I really do need that correction.
All right. And I know some of the names that you do like are Verizon, Caterpillar, MasterCard. Caterpillar, of course, recently has been at 2-year highs. Blurina, let me turn to you. I know you look a lot more at the fixed income side of things. So are we ever going to see rates move up in a meaningful way, given everything that the Fed's trying to do here? Or are we just parked in this range?
Kelly, everything is telling us that we will most likely be in this slow recovery and low interest rate environment for a while. Chairman Powell indicated that the expectation is inflation is not going to reach 2% until 2023. So since that 2% has to be on track for quite some time, along with maximum employment, in order for the Fed to look at increasing rates, in our opinion, we will be in this low interest rate environment for quite some time. So even looking at where the Treasury is or where the single A corporate index is, there's not really much reward for extending in term or taking any additional credit risk, as we're going from a quarter basis point in the 5-year Treasury to 1.44 in the 30-year Treasury,
right.
Where the equivalent 5 and 30-year single A corporate is 79 and 2.69. So there's not much reward there, and everything it's pointing to fixed income will stay in this low interest rate environment for quite some time.
Blurina, let me ask you, what would happen if there was no more stimulus from Washington? And let's all keep in mind, just a month ago, we assumed this was a done deal because the economy needed it and the market would demand it. And today it doesn't so much feel that way, but we continue to get these warnings about what happens to the economy in its absence. How big a toll would it take, do you think?
In our opinion, that's already priced in. We are looking at lower odds of that happening, especially until year end. And with elections coming up, I feel like politics are going to play, each side is going to play that to their advantage. And the Democrats might stall this as long as they can until after the elections are over. So that's already priced in that low
Wow.
probability for sure.
But that's if it's already priced in, then that means there's no downside. If the market's already pricing in no more stimulus, then what you're looking at now reflects no more stimulus. It's hardly an unpleasant surprise around the corner.
I would caveat.
Go ahead. Yep. Quick last word.
I would caveat that with until year end, things could change probably after the election, but we expect some volatility during the election and possibly some stalling from the Democratic side.
Absolutely. Yeah, no, that's its own kind of headwind to get through.